Welcome back to House Rich, home of the world's best home buying tips. Today we're going to talk about student loans, how they impact the home buying process if you're using a mortgage. So the most commonly asked question I get is, hey, I got student loans, can I still buy a house? The answer is yes. So if that's all you came for, you're welcome. I guess like, subscribe to the video, see you way out, tell a friend to tell a friend. For everybody else, what I'm going to do is I'm going to break down the mortgage guideline, or actually I'm going to read the mortgage guidelines for you, and then I'm going to translate them into layman terms. So let's jump into it. So the first thing you need to understand is, like when you go get a loan from Chase, I always mention Chase, that's my default company, Chase. And so these loans are insured by what's called like government, GSEs, government sponsored enterprises. So like when you get a conventional loan, you may have heard the term like Fannie Mae, Freddie Mac, Fannie, Freddie. Those GSEs or government sponsored enterprises insure those loans. And so that's why there are different guidelines, like for a conventional loan, than an FHA loan, than the USDA loan, or FHA loan, is that there's different organizations that insure those loans. So for an FHA loan, that organization is the FHA, the Federal Housing Administration. For a USDA loan, it's the USDA, the United States Department of Agriculture. And for VA, it is the VA, the Veteran Affairs Administration. Let's go with the Veteran Affairs Administration for VA. So what I'm going to do for you is I'm going to actually read this off this chart, the bank rate put together. So I'm going to give a big shout out to the bank rate. And so I'm going to read how student loans are impacted for a conventional loan, for Fannie Mae and Freddie Mac. So for Fannie Mae, monthly student loan payment as listed on a credit report or student loan statement, if deferred or in forbearance, either 1% of the balance or one monthly payment. That one monthly payment is a super important thing to know for Fannie Mae, because I'm going to actually read you directly from Fannie Mae's website, because it's super important that if sometimes you're in like a income-based repayment plan and your balance may be zero. And so what do you do in that scenario? So with Fannie Mae, if your income-based repayment plan has a payment of zero, the lender can actually use zero. So believe it or not, I'm going to actually read this directly off of the Fannie Mae website. Exciting readings, today. So it says, how are student loan payments calculated if a monthly income-driven repayment plan is zero? So Fannie Mae says, as long as the lender can provide documentation showing the income-driven repayment plan is zero, then they can qualify the borrower for $0 for the monthly qualifying payment. So, boom, if the payment is zero and you're going with a Fannie Mae type of conventional loan, they can use zero there. So that's super important for you to know. Let's check out the other guidelines. So for Freddie Mac, it says, your monthly student loan payment as listed on the credit report or student loan statement, if deferred or in forbearance, 0.5% of the balance. And so that's how it goes for Freddie Mac. So those are for your conventional loan. So with a Freddie Mac, if there's not a balance, basically it's 0.5% of the balance. So let's jump into FHA. So FHA was recently changed, I think October of last year. It used to be a killer. It used to be that basically 1% of your balance if the loan is in deferment. It was either the higher of 1% or the monthly payment if your loan was in for an FHA loan. And so essentially it was always 1% of the balance for an FHA loan, which is a killer. Because think about it. If you got $100,000 in student loans, 1% of that is $1,000. Your actual payment may be $200, $300, something like that. And so you're kind of screwed. It was kind of very, very hard to get a loan with the FHA. So FHA in October, I think, of last year, changed their requirements. So I'm going to read you their requirements here. Monthly student loan payment as listed on a credit report or student loan statement, if deferred or in forbearance, either 0.5% of the balance or one monthly payment. So essentially, if your student loans are in forbearance and you don't have a payment, they're going to use 0.5% of the balance. Still pretty high, like higher than it would be if you were actually making a payment. So in that same scenario, for a $100,000 student loan balance, it'd be $500 towards your debt to income ratio, which is a grand canyon of a difference for most people there. And so, not ever telling you to do this, but sometimes it may make sense to take your loans out of deferment, because instead of, if it's going to impact your debt to income ratio, because not professional, not financial advice, but it may make sense to do this sometimes, just because, think about it, that could greatly impact your debt to income ratio. A $500 payment versus like maybe take them out of the deferment, and maybe your payment is $100. That's a $400 difference in your debt to income ratio, which is, I don't know, almost like a $100,000 house, depending on what the rates are when you watch this video. So for VA, it gets a lot harder. So it's your monthly student loan payment as listed on the credit report or student loan statement, or 0.5% of balance divided by 12, whichever is higher. If it's deferred, it's not included in underwriting. So if it's deferred, it's not counted towards underwriting. And then for USDA, it's your monthly student loan payment as listed on your credit report or student loan statement. If deferred, in forbearance, or in an income-based repayment plan, either 0.5% of the balance or 1 monthly payment. So essentially, if you don't have a payment, if you're in deferment, unless you have a conventional loan, which is under the Fannie Mae guidelines, you're basically going to be using essentially 0.5%. Most likely is what it's going to be as far as your student loan payment. So that's a quick breakdown. Hopefully that helped you. So what happens if student loans get forgiven? And now your balance was $50,000, and now it goes. I'll say $10,000 gets forgiven. It goes down to $40,000. It's the same math. It's 0.5% of that balance, or whatever your monthly payment is, if that happens to change as well. So hopefully that helped you out. Tell a friend to tell a friend. Thank you. Short video today, or short podcast. Thanks.